Snowflake just delivered the worst earnings report I've seen all season. Then again, I only cover stocks I like. And Snowflake. It's a joke, it's a joke. Okay, so yeah, Snowflake stock currently trades at $135.06, up 2.38% during hours, after hours down 8%. So I guess the market didn't like something. Let's find out. So yeah, market cap's $45 billion, and I like this first article. Is Snowflake Incorporated the best big data stock to buy now? Let's find out. So before we get into it, Shamao says to like and subscribe. So yeah, let's get into it. What's first? What's first is a couple day old news story. Warren Buffett has sold, well, his company Berkshire has sold all of their Snowflake stock that they held since pre-IPO. So they're gone. They said no mas, no mas. So let's get into it. What actually is in the earnings report? Well, here it is. Here's the earnings report. So what do we have? I'm going to hide myself for a bit. I'll come back later. This way you can see more of the screen. Okay, so yeah, Snowflake reports financial results for the second quarter of fiscal 2025. Product revenue of $829 million, representing 30% year-over-year growth. Net revenue retention rate of 127%. That is a fantastic number. Essentially, you might be thinking, how can you get a net retention revenue rate of more than 100%? How is that possible? How is it possible is their existing customers are buying more. They're spending more for Snowflake's products. So that's a great number. I think it might be slowing from the previous quarters, but still a great number. So yeah, they have 510 customers with a trailing 12-month product range. Let me get myself back. With a 12-month product revenue greater than $1 million, 736 of the top 2,000 Forbes Global 200 customers, a reported RPO of $5.2 billion, representing 48% year-over-year growth. Also, that is a fantastic number. No kidding, fantastic number. And they authorized a repurchase of an additional $2.5 billion under their stock repurchase program through March 2027. Now, I'm going to get into this later, but that's actually a bad idea. A very bad idea. Why? I'll show you. I'll show you later. But trust me on this one. So yeah, let's just dig into it. Let's see the actual comment from the CEO. This is their new CEO. They fired the old guy. This is the new guy. I like him better than their previous CEO. This is a data guy. This is an engineer. So he's much better than the previous business guy, the MBA guy. So he's here to turn around the company. I have some advice for him in this video. I have some clear-cut advice for Snowflake later in this video. So yeah, Sridhar says Snowflake delivered another strong quarter, surpassing the high end of our Q2 product revenue guidance, and as a result, we're raising our product revenue guidance for the year, said the CEO. Product revenue is up 30% year over year at $829 million, while RPOs were $5.2 billion, up 48%. We read that. The quarter was hallmarked by innovation and product delivery, and great traction in the early stages of our new AI products. With the combination of our platform, the network effect of collaboration, and our AI innovations, we have a huge opportunity ahead to deliver even greater value to our customers. So that's great. Let's move on. So honestly, for a data company, this table was organized horribly. They should follow the standard format because this is difficult to read. And yeah, for a data company, they did bad on this one. They got to fix this. This is unreadable. So yeah, you can see here product revenue is $829.3 million, year-over-year growth 30%, because they split a GAAP and then non-GAAP, and then they cut it away this way. So it's like it's just difficult to read because you have some cases where there's data filled, other cases where it's not filled, other cases where it's filled on the right side, but it's not filled on the left side. So, what's going on? Yeah, all these blank fields make it weird. But anyway, moving on. Product gross profit, 72% margin. Operating income and loss is negative 41%. This is the reason why I said that this is the single worst earnings report I've seen this season. An operating loss of 41% is horrible. I'm going to get into why that number is what it is. So net cash provided by operating activities is $69.9 million. This is for the second quarter. Year-over-year growth of 8%. And free cash flow is $58.8 million non-GAAP. And then adjusted free cash flow is $66 million. Okay, so getting back to my first statement, why is the $2.5 billion stock repurchase program a bad idea? It's a bad idea because they can't afford it. I'm just going to be frank. They can't afford it. They're only producing $60 million in free cash flow per quarter. I mean, do the math yourself. If they're only increasing this, X amount per year, they just can't afford it without taking out debt. And you should never take out debt to buy back shares. Never. You should never take out debt to buy back shares. So they just can't afford this repurchase authorization. They don't make enough money. And this is on the non-GAAP side. And we're going to get into the GAAP results. We're going to get into the GAAP results. So yeah, third quarter guidance is revenue of $850 to $855 million, a year-over-year growth of 22%, which by itself is pretty good, but it's slowed significantly from prior years. You can see here the growth of the prior years, and it has slowed significantly. Oh, I can't get that. All right, so yeah, getting back to it. So yeah, that's actually an improvement product revenue. So that's an improvement of $830 million. So quarter over quarter, they're anticipating about $20 million more in product revenue. For the full year, they're expecting year-over-year growth of 26%, product revenue of $3.356 billion, product gross profit margin 75%, operating income margin 3%. This is non-GAAP. Non-GAAP margin 3%. There, you notice there's no guidance for GAAP operating income. No guidance. And adjusted free cash flow margin of 26%. And that's not going. There it goes. All right. So anyway, weighted average shares using computing net income per share, yada yada, 361 million shares. Okay. So let's get into it. In February 2023, our board of directors authorized a stock repurchase program of up to $2 billion of our outstanding stock. As of that, $491 million remained available and blah, blah, blah. I don't care. But they authorized an additional $2.5 billion, which I don't think they can afford. Even if it goes out to 2027, they're going to have difficulties affording this without taking on debt. It's going to be hard. So yeah, let's get into it. Just nonsense. Let's skip it. I'm gonna hide my face again. Who wants to see me? Who wants to see me? I don't even want to see me. I don't even want to see me. Okay. So what do we have? We have most of this we already went over. Okay. So here's the thing. Okay. So yeah, revenue is $868 million. Cost of revenue is $288 million. Gross profit is $580 million. Now here's where the first issue lies. The first issue lies in the sales and marketing of $400 million in this last quarter. $400 million, 625. Now that is half of the total company revenue. That is a massive number. This is one of the major reasons why the operating loss is $355 million. This is insane. I mean, just think of it this way. Their salespeople are making, look at it, revenue $868 million, sales and marketing expenses $400 million. That means, sure, subtract some for marketing, whatever, but you can look at it this way. Their salespeople are making an exaggerated number of 50%, 50% sales. 50% of the revenue is going to the salespeople. That is an insane number. Commission, 50% commission is the number I was looking for. The word. My English skills are failing me. Research and development, $437 million. That's half. Half of all revenue is going to R&D. General administrative, $97 million. Total operating expenses, $936 million. Just the operating expenses exceeds the revenue significantly. It's insane. It's insane. The only good part is the interest income is $49 million. Say a negative operating loss is $355 million. You got a loss before income taxes, 333, yada yada. Net loss, $317 million. Okay, so that's issue number one, is they're spending too much money on their salespeople, and their salespeople are unproductive. This is non-productivity, especially on the R&D side. The R&D people, let me bring myself back. The research and development people, for every dollar you spend on research and development and they give you $2, that is a terrible ROI. That is a horrible ROI. It should be at least 5 to 1. You should be getting far more results from your research and development. It should be 5 to 1, not 2 to 1. That is horrible. And their sales and marketing also is 2 to 1. I mean, it's just insane. Okay, but why? Why are things looking this way? Things are looking this way because of stock-based compensation, which we'll get into one second. Okay, the other thing is they have cash and equivalents of $1.2 billion and short-term investments of about $2 billion. That's actually a decrease from January 23rd, or January 2024. So over 6 months, this actually decreased $500 million. So $500 million of cash disappeared off the balance sheets. And on top of that, their net working capital also decreased about $1 billion. We're going to get into that, and actually, let's get into that now. Let's get into that now because that is horrible. So yeah, for the income statement, you can see right here, and really that orange bar is what we were paying attention to. This is the operating income. And Sridhar's got his work cut out in front of him, and honestly, it's not that hard, I don't think. I don't think it's that hard to fix what they have. Free cash flow is good. But the main problem is here, stock-based compensation. It actually matches free cash flow. It's identical to free cash flow. Okay, so yeah, what I was mentioning earlier is working capital. So what is working capital? Working capital is your current assets minus your current liabilities. So essentially it means it's your ability to function throughout the next 12 months is what that means. And you can see here it's declined from $4.4 billion in Q3 of 2020, when they went public, and it's just been getting worse and worse every single quarter, just about. Nearly every quarter it's gotten worse and worse. Now it's $1.43 billion of working capital. And when this gets low enough, they're going to have to start issuing debt. I mean, they got to fix that. So the other thing is stock-based compensation. That's why this number is increasing. Even though they're buying back shares, this chart's broken. But anyway, even though the company's buying back shares, the shares outstanding is increasing. This is because of the operating loss. They're losing money, so they literally can't afford their stock-based compensation from their free cash flow. Because look at it. Going back here again. Okay, so we have these cash flows. So stock-based compensation is right here, $356 million in stock-based compensation. Do you have any idea how much money that is compared to their revenue? Okay, so $356 million in stock-based compensation in 3 months on revenue of $868 million. That is a stock-based compensation of 41% of revenue. That is enormous. Their employees aren't producing enough. They're just not producing to even pay for their own stock-based compensation. This is 41% of revenue. It's increased significantly over the last year. It's huge. Let's go. I don't want to harp on it too much, but let's just move on. What else do we have? Other stuff, cost of revenue, blah, 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 blah. Okay, so yeah, their stock-based compensation is far too high. The working capital is working in the wrong direction. And okay, so what Snowflake needs to do is this. Sridhar, my recommendation is to cut down on sales and marketing. They're not doing their job. If you have to spend $400 million on sales and marketing to achieve $868 million in revenue, something is wrong. Something is broken. Because remember, this revenue, most of this revenue is just recurring revenue from previous years, previous quarters. Where is that money going? Your salespeople make too much money, or there's too many of them. I think it's both. I think there needs to be a headcount reduction significantly in the sales and marketing division. I'm talking like 50%. I'm thinking they need a 50% headcount reduction in sales and marketing, and they need to restructure their stock-based compensation, because 41% of your revenue going towards stock-based compensation, well, not going towards, but represented by stock-based compensation, means essentially money's being taken from you, the stockholders, and given to the employees. That's basically what's going on. Money's going from you, going to the employees, day after day after day. So the stock-based compensation on the entire organization needs to be rethought, because the employees, they're just not producing results. We're not seeing the results commensurate of how much money they make. I mean, these people make like $200,000 each in stock-based compensation. Do you think they're producing the results needed for $200,000 in SBC plus their base salary plus bonuses? I don't think so. Not for a 29% revenue gain. It's just not fast enough. So yeah, also sign up for my Patreon. I have a fantastic offer going on. For only $5, you can get access to my Patreon portfolio. You can view all my purchases, all my sales, as I grow this portfolio from $0 to $1 million. And what this will do is it will give you access basically into how I think, how I design, and how I set up a winning portfolio that will significantly beat the stock market over the long term. Also, I do DCF valuations and corporate analyses. I have Tesla, I have Nvidia, I have AMD, Intel, Microsoft, Nike, and so many other companies. I do over 15 different stocks. And yeah, it's all up there on my Patreon. Some of the corporate analyses go upwards of 16 to 20 pages of detailed reports on each company. And these DCF valuations, they are full Excel documents. You can go in and just modify the numbers as you see fit, modify the forward projections, and it will automatically calculate that company's intrinsic value for you. So yeah, this offer is just the best offer you'll ever find. So yeah, with that said, don't forget to like and subscribe. Thank you for watching, and I'll see you in the next one.